Hi friends, today I'm going to explain the difference between ELSS and PPF and hopefully help you choose which investment product out of these two to go for while planning for your tax saving investments. So just to give a brief overview of what is ELSS and what is PPF. So, as we know, PPF or Public Provident Fund is a tax saving investment that is backed by the Government of India. It has a locking period of 15 years by default, and the interest is determined by the Ministry of Finance every quarter. The current rate of return from 1st January 2021 is 7.6%, and under Section 80C, the money invested in PPF is eligible for tax deduction. A minimum amount of rupees 500 and a maximum of rupees 1.5 lakhs can be invested every year. On the other hand, what is ELSS? ELSS or Equity Linked Savings Scheme is, as the name suggests, an equity product. It is a diversified equity mutual fund that spreads the corpus across stocks of companies with varying market capitalizations. Under Section 80C, the money invested in ELSS funds is totally exempt from tax. They have a low lock in period of 3 years, after which the whole money can be withdrawn. Any amount can be invested per annum, but up to rupees 1.5 lakhs maximum is eligible for a tax deduction. So now that we know what are these two types of investments, let's find out what are some of the major differences between them. So hopefully that can help you to come to a decision of which one to choose. So if we look at the risks involved, right, the comparison between the two. So in ELSS, it being an equity fund, the investments are subjected to market risks. Whereas on the other hand, PPF is a safe option as it is guaranteed by the Government of India. On the returns front, ELSS is linked with the performance of the stock market. On average, an investor can expect to get around 12 to 14%. For PPF, the rate of interest is dynamic and decided by the Ministry of Finance every quarter. Presently, it is 7.6%. From the tax benefits perspective, ELSS is triple E, exempt, exempt, exempt. So what that basically means is the invested amount is exempt from taxes at the time of investment, accumulation, and withdrawal. Same applies for PPF as well. It is also triple E, which is exempt, 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 exempted at the time of investment, exempted at the time of accumulation, and exempted at the time of withdrawal. The lock-in period for ELSS is 3 years, whereas that for PPF is 15 years. Maximum duration of the investment for ELSS there is no limit. Similarly for PPF also there is no limit. Initial investment period for PPF is 15 years, and after which it can be increased by blocks of 5 years each. The maximum amount of investment in ELSS there is no upper limit. However, max 1.5 lakh rupees is eligible for tax deduction under Section 80C. For PPF, the minimum investment is rupees 500 and the maximum is rupees 1.5 lakhs every financial year. From the above table, it is clear that PPF is a relatively safer option but offers lower returns and longer time horizon as compared to ELSS. With the tax benefits being the same, ELSS certainly is a better tax saving alternative to PPF provided you have the appetite for market volatility. Just to give an example, let's say we have to understand, first of all, we have to understand that investments in tax saving investments are not only to save tax but also for long term wealth creation. And we are talking about, right, rupees 1.5 lakhs of hard earned money invested every year. So if an individual invests, let's say, around rupees 12,500 every month in ELSS funds for 15 years, then his investments would grow to rupees 61 lakhs as compared to 29 lakhs in PPF. So from all these comparisons and the tax benefits being the same, I would say that ELSS certainly is a better tax saving alternative, but provided you have the appetite for market volatility. So now, depending on your risk appetite and your preference of investment, it is up to you which one you want to go for. But personally, I would suggest ELSS due to the much higher returns it offers over the long term. and the risks also reduce with time. So I would personally suggest ELSS, but the final call is yours. Thank you.